Hi guys, I hope you're doing well. There is a query about impairment of financial assets, so I thought that maybe I could just have a quick explanation of the impairment of financial asset. Now, when we talk about the impairment of financial asset, there are things that you actually need to consider. There are things that you need to understand. And what exactly are those things? Number one of them is the impairment of financial asset is done under IFRS 9. Don't apply IAS 36 to the impairment of financial asset because the IAS 36 is not applicable to financial asset. Now, when it comes to IFRS 9, we now have got the expected credit loss approach that's applicable. What is this expected credit loss approach? So expected credit loss approach means you need to understand that what a credit loss is. So the credit loss is when you have extended credit to somebody, the likelihood of the amount that is not going to be recovered. So the credit loss is the amount that will not be recovered. So like, for example, if you have given $100 to somebody, and if there is, let's say, there is a chance of $12 not being recovered. So we would say that there is a credit loss of $12. Now, what generally happens is that under the IFRS 9, we've got a terminology which is called the expected credit losses. Now, what exactly are these expected credit losses? Let's discuss about these. The concept of expected credit losses is that as an entity, you could do multiple types of estimations, multiple types of estimations of the total loss that is going to be incurred. Like maybe possible, there is going to be a loss of $20, there's going to be a loss of $10, there's going to be a loss of $5, there's going to be a loss of $3. So you could have the multiple expectations of the different type of losses that could arise. Now let's say you say that there is a 10% chance of the loss being $20. There's a 30% chance of the loss being $10. There's a 40% chance of the loss being $5. And there is the remaining, which is basically going to be 20% chance of the loss being $3. Now, if you have got these different type of chances, so resultingly what happens is that 20 into 10% gives you 2. Then there is this 10 into 30% gives you 3, 5 into 40% gives you 2 again, 3 into 20%, this actually gives you 0.6. So hence resultingly what happens is that we would say that 2 plus 3 plus 2 plus 0.6, 7.6 is going to be the expected credit loss. So you would realize that what I expected credit loss is that we incorporate the effect of the probability in order to establish the expected credit loss. Now let's move a bit forward and let's discuss further. So there are basically, if I could just mention ECL, the expected credit loss. The expected credit losses could be of two types. What are those two types of expected credit losses? One of them is a lifetime expected credit loss. And there is the second one, which is a 12-month expected credit loss. Now, what is this lifetime expected credit loss? What is this 12-month expected credit loss? The concept of the 12-month expected credit loss is that the likelihood of the loss in the next 12 months, the likelihood of the loss in the next 12 months is going to be the expected credit loss for the 12 months. What is the lifetime? Let's say if there is a bond in which you have invested, and if there is a 5-year life for that bond, the 5-year life of the bond would actually mean that the expected credit losses over a period of the entire life of 5 years, that is going to be the lifetime expected credit loss. Now, when we talk about this expected credit losses, so there are basically these two types, the 12-month and the lifetime expected credit loss. Now, how do we actually account for it? So first of all, let's actually talk about that when you recognize a financial asset initially. So by default, you would recognize a 12-month expected credit loss. Like for say, you invested in the bonds and the investment in the bonds is of $100,000. There's a 12-month expected credit loss of, let's say, $2,200. So what you're going to do is that you're going to say financial asset debit by 100,000 and correspondingly cash is going to be credited by 100,000. Then what happens is you're going to say the profit and loss account is going to be debited by 2200. And what happens is that allowance for impairment is going to be credited by 2200. Or if you don't write it allowance for impairment, you could actually say the loss allowance. Now, subsequently, what is going to happen is that, let's say at the end of year two, if the 12-month expected credit loss increases to, let's say, 2500, so what are you going to do? You're going to simply say P&L debit by 300, and the loss allowance is going to be credited by 300. That's what you're going to do. Now, let's just discuss a bit further. At times, what happens is that when you acquire a bond, so at times resultingly, what happens is that there is a significant deterioration. There's a significant deterioration in credit risk. So what does IFRS 9 says? IFRS 9 says that in case if there is a significant deterioration in the credit risk, in that case, what you need to do is that you now need to recognize the lifetime. You now need to recognize the lifetime expected credit losses. You now need to recognize the lifetime expected credit losses. So basically what would happen is that your loss allowance, maybe let's say the lifetime expected credit loss was, let's say, 11,500. So what you would simply do is that you're going to update this loss allowance to 11,500. So the difference between this 11,500 and 2,500 is what? Is 9,000. So what are you going to do? You're going to simply say that P&L is going to be debited by 9,000 and the loss allowance is going to be credited by 9,000. So whenever you've got a significant deterioration in the credit risk, so resultingly what you're going to do is that you're going to change your loss allowance from the 12-month expected credit losses to lifetime expected credit losses. That's what you're going to do. Now, the last thing, which is basically at times what happens is that a loss event actually does happen. Like loss event does actually happen means maybe you have defaulted on a loan, maybe you've defaulted on a loan, maybe you've defaulted on the interest payment, or maybe you have declared to some other creditor that we are not going to be making the payments. So in that case, what happens is that that's an indication of impairment. And when there is actually an indication of impairment, so resultingly what happens is that we would actually recognize it like this. We are going to simply say that again the P&L debited by whatsoever amount, and at the same time the financial asset is going to be credited by XYZ amount. But the difference that's actually going to arise when it's going to be here, the difference that's going to arise is that normally you have got a normal effective interest rate. Let's say you've got a normal effective interest rate of 12%, the cash interest rate of 10%. This normal effective interest rate is going to be applicable on the par value when the financial asset has not been impaired. But in case if there is a impairment loss that is arising on the financial asset, so what would happen is that the effective rate is going to be applicable on what? The effective rate is going to be applicable on the revised carrying amount. It's actually going to be applicable on the revised carrying amount. What do you mean by revised carrying amount? The revised carrying amount is basically, let's say if there was this 100,000 as the original par value of the bond, and then what happens is that there was this $20,000 as an impairment loss. So now this is going to be applicable on 80,000. At times what happens is that when you acquire a financial asset, it's already credit impaired. So in that case, what happens is that the effective interest should incorporate the effect of impairment loss. The effective interest should actually incorporate the impairment loss. The effective interest should actually incorporate the impairment loss, right? So that's how you go about dealing with the impairment of financial asset. I hope that this video was of use for you people, and you would actually enhance your understanding of the impairment of financial asset. In case if you do have any further question, do let me know.